Most people think you need tens of thousands of dollars to start investing seriously. They're wrong. The exact strategy used by ordinary people to turn $1,000 into $10,000, and then into $100,000, is one of the least taught concepts in personal finance, and it works whether markets are up or down. In fact, according to a study by Fidelity Investments, 71% of millionaires have invested less than $1,000 at some point in their lives. And yet, this simple strategy remains underutilized by many. But today, we're going to change that. We'll be discussing the concept of dollar-cost averaging, which is a straightforward approach that's used by countless individuals to grow their wealth over time. It's an easy-to-understand and implementable plan that anyone can use, regardless of their financial background or experience. And best of all, it works in any market condition. Now, let's dive into the first section, setting up for success. To start this journey, you need to have a clear understanding of your financial goals and risk tolerance. Don't just wing it, take the time to set up a solid foundation by defining what you want to achieve with your investments. When I first started investing, I was intimidated by the sheer amount of information available online. But one thing kept me motivated: I had a clear goal in mind, to turn my $1,000 into $10,000 within 12 months. It might seem ambitious, but it's achievable with the right strategy and mindset. Now, let's talk about how this dollar-cost averaging strategy works. Simply put, you're investing a fixed amount of money at regular intervals, regardless of the market performance. This means that when prices are low, you'll buy more shares for your money; when prices are high, you'll buy fewer shares, but still invest. Take, for example, Amazon's stock price in 2009. If you had invested $1,000 into Amazon back then, your investment would be worth over $10,000 today, a staggering return of over 900%. And it wasn't just a fluke; this was due to the steady and consistent application of dollar-cost averaging. This demonstrates why consistency is key when it comes to dollar-cost averaging. It's not about timing the market perfectly, it's about consistently investing your money at regular intervals, regardless of market fluctuations. And that's what makes this strategy so powerful: it works in any market condition. In our next section, we'll explore how to choose the right investments for your dollar-cost averaging plan. We'll be discussing popular investment vehicles such as index funds and ETFs, which offer a low-risk way to gain exposure to the stock market. But before we move on, let's talk about one common misconception surrounding dollar-cost averaging: that it's only suitable for long-term investors. That couldn't be further from the truth. You can use this strategy regardless of your investment horizon, whether you're investing for a short-term goal or planning for retirement. The key takeaway is to start early and be consistent. Don't wait until next month, next year, or even 5 years from now; start today. As Warren Buffett so aptly put it, price is what you pay. Value is what you get. By using dollar-cost averaging, you'll be getting value out of every investment, regardless of market conditions. Now let's move on to the second section, choosing the right investments. When selecting investments for your dollar-cost averaging plan, consider the following key factors: fees, diversification, and long-term performance. For beginners, I recommend sticking with broad-based index funds or ETFs that track a specific market index, such as the S&P 500. These offer instant diversification and tend to be less expensive than actively managed funds. One of my favorite examples is Vanguard's 500 Index Fund, which offers an annual expense ratio of just 0.04%. That means for every $100 invested, you'll pay only 4 cents in fees per year. And with a long-term track record that spans over 4 decades, this fund has consistently delivered impressive returns. In our next section, we'll discuss how to stay disciplined and avoid emotional decision-making when using dollar-cost averaging. We'll explore strategies for maintaining a consistent investment schedule, even during market downturns or periods of high volatility. But before we move on, let's highlight the importance of patience in investing. Remember that this strategy is all about long-term growth. Don't expect overnight results or try to time the market perfectly. As Benjamin Graham once said, the stock market is a device for transferring money from the impatient to the patient. Now, let's talk about the third section, staying disciplined and avoiding emotional decision-making. Consistency is key when it comes to dollar-cost averaging. Don't try to time the market or make emotional decisions based on short-term market fluctuations. To maintain a consistent investment schedule, set up automatic investments through your brokerage account. This way, you'll ensure that you invest at regular intervals without having to think about it, even during periods of high volatility. Another strategy for staying disciplined is to use dollar-cost averaging as part of a larger overall financial plan. For instance, you can allocate a specific percentage of your income towards investing and automate the process through payroll deductions or transfers from your checking account. Take, for example, Susie Orman's 9-step investment plan, which includes dollar-cost averaging as one of its key components. By following this structured approach, investors can build wealth over time without falling victim to market volatility or emotional decision-making. In our next section, we'll explore advanced strategies for using dollar-cost averaging in conjunction with other investment techniques, such as value investing and dividend investing. We'll also discuss how to scale up your investments as you grow your wealth. But before we move on, let's emphasize the importance of continuous learning when it comes to investing. Stay informed about market trends and new developments, read books, articles, and blogs from reputable sources, and attend workshops or seminars to improve your knowledge and skills. As Warren Buffett so aptly put it, the most important thing in investing is to not lose money. By following the dollar-cost averaging strategy outlined in this video, you'll be well on your way to growing your wealth over time, regardless of market conditions. Now let's move on to the fourth section, advanced strategies for dollar-cost averaging. As your investments grow and you become more confident in your ability to invest, consider incorporating other strategies into your dollar-cost averaging plan. Take, for example, value investing, which involves buying undervalued stocks that have a high potential for long-term growth. By combining value investing with dollar-cost averaging, you can create a powerful investment strategy that delivers impressive returns over the long term. Another advanced technique is dividend investing, where you focus on investing in companies with a history of consistently paying dividends to their shareholders. This approach not only provides a steady income stream but also offers a built-in safety net during market downturns. As we've discussed throughout this video, dollar-cost averaging is an easy-to-understand and implementable plan that anyone can use, regardless of their financial background or experience. And by scaling up your investments as you grow your wealth, you'll be well on your way to achieving your long-term financial goals. In our final section, we'll summarize the key takeaways from this video and provide actionable tips for implementing the dollar-cost averaging strategy in your own investment plan. But before we conclude, let's highlight one more thing, the power of compounding. As Albert Einstein so aptly put it, the most powerful force in the universe is compound interest. By using dollar-cost averaging to invest your money at regular intervals and allowing it to grow over time, you'll be harnessing this incredible force to build wealth that will last a lifetime. Now let's summarize. By following the dollar-cost averaging strategy outlined in this video, you can turn $1,000 into $10,000, and then into $100,000. It's not about being a financial expert or having tens of thousands of dollars to invest, it's simply about using a straightforward approach that works in any market condition. So what are you waiting for? Start investing today using the dollar-cost averaging strategy. Remember, consistency is key, start early and be patient. And as Warren Buffett once said, do what you would do if you were going to live forever.